Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Target has been through a lot of turmoil over the past year. Shares are actually down 14.7% in the past year as I'm recording, but the dividend yield is starting to be really attractive for Target. 3.4% right now, should be able to steadily grow over time. And I think this could be a great buying opportunity for a company that still has a lot of growth potential and has started to find its place in the retail market. So that's what I want to dig into today. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. Check out my newsletter, Asymmetric Investing. And if you're in the DC area, check out the Money Collaborative event that I'm helping put on August 18th. Got a link to that in the show notes. Now, I want to start here with this chart to just show what Target's trajectory is over the last 5 years. You can see that revenue is just up tremendously. This was one of the huge beneficiaries from the pandemic. People started to really appreciate the same-day services that Target has. That's drive up, pick up, and then also their ship delivery service. Really made those brick and mortar assets much more valuable. And the interesting thing, I think, in this chart from a revenue side is that Target has not given up the growth that it gained during the pandemic. We've seen with a lot of companies, there was a bounce in revenue during the pandemic. And then as people kind of went back to work, went back to normal life, things reverted back to their old ways. That has not happened with Target. But on the net income side, the story is a little bit different. You can see that net income was great during 2021 and early 2022. Over the past year, that has really reversed. There are a couple of reasons for that. The main one is that coming out of the pandemic, Target was really prepared with the wrong kind of inventory. So they were expecting people to buy outdoor furniture that they were buying during the pandemic, and they prepared for that. And it turns out demand for those kind of products just absolutely reversed. And people went back to buying things that they were buying in 2019. Target has a very long lead time in preparing their seasonal orders. So when you start to get the inventory mix wrong, it can actually take a year or more to get things back to a normal level. So that's a lot of what we're seeing with that drop in net income. I think the normal level of net income right now is going to be more like $3.5 to $4.5 billion on an annualized basis. But even at this lower level of earnings, you can see that the payout ratio at Target is only about 70%. And on a normalized basis, we're going to be probably back to historical levels of between 40 and 50% payout ratio. That's the percentage of net income that Target is paying out as a dividend. That's a good payout ratio. That's a good payout ratio for a dividend payer. Gives management the ability to potentially buy back debt or shares, can also expand the business where that's appropriate. So this payout ratio seems high right now, but given the one-time nature of the inventory challenges that I highlighted earlier, I think this is actually an okay place to be. Now, broadly, I think Target is finally in a position where it's a much more stable business than it was 5 or maybe 10 years ago. It's really leaning into the physical brick and mortar locations that it has. I mentioned those same day services. Drive Up is something that I use on a regular basis because it's just so easy to put in your order online and go pick it up in an hour or two. Pick up, same thing, and then Shipped is their delivery service. I think they're going to continue to lean into that in what I call grocery plus. You may go to Target to buy groceries, and then you're going to add other items that are adjacent, that are only available at Target, not necessarily available at a specific grocery store. That's a phenomenal position to be in when your competition is places like Amazon, who has all the inventory in the world, but maybe can't get you products in an hour or two, or other more niche retailers like a grocery store, like a fashion shop. Target is really one-stop shopping for a lot of these things, and adding in those digital services has been a phenomenal move for them. Solid dividend yield at 3.4%. The ability to grow that, and I think earnings and revenue will continue to grow slowly but surely over time, puts Target in a really good position. This isn't a stock that's going to knock your socks off, but if you're looking for a steady dividend payer that's going to grow over time, I think Target should be on your list. What do you think? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.